Would you wear the same shoes for every occasion? Or rock the same outfit 7 days a week? Of course not. Your style is better with options. Your investments could be too. SIBO Index options give you access to various contract sizes, global trading hours, and potential tax advantages. That's a good look for any portfolio. If you're ready to invest in style, head to betterwithoptions.com. There are risks associated with SIBO company products. Review the disclosures and disclaimers at sibo.com/US_disclaimers.
This is Optimal Finance Daily, 8 secrets your broker won't tell you and why you need to know them, by Jeff Rose of goodfinancialsense.com. I have a little secret for you. Your broker might not have your best interests in mind when they make recommendations to you. In fact, brokers can legally put their interests ahead of yours. Did you catch that? Translated, that means that your broker can get a speeding ticket for going 75 miles per hour on the interstate, but won't get punished for selling you a investment that makes them a bunch of money. This is because most brokers operate under what's called the suitability standard, which simply means the securities they recommend must be appropriate for you given your financial profile. However, many of the securities that can be considered suitable may be far from the best investment options available at a particular time. How do you like them apples? You may be surprised to learn that brokers working under the suitability standard are not legally obligated to find the best prices or the best investment options available at a particular time. As a result, your broker may offer you securities that provide lower returns and carry more significant risk than other alternatives, as this may be more profitable for the broker. The suitability standard can apply to brokers that sell insurance, stocks, annuities, or other investment types. Number 1, brokers make money even if you don't. This is because of the commissions-based compensation model presently used by many brokerage firms. Let's say your broker convinces you to buy into XYZ stock at $50 per share. If the price subsequently increases to $60, then your broker may call you and advise you to buy more of the same security because of the 20% appreciation in price. This transaction would then generate a commission for your broker. On the other hand, let's say that same investment in XYZ stock instead dropped to $40 per share. In this case, the same broker might call you and still tell you to buy more of this same security, because it's now less expensive than it once was and should therefore be considered a bargain. This transaction would also generate a commission for your broker. Great for them, not so much for you. As you can see, your broker's success can have little relation to your own. This represents a misalignment of interests that might cause your broker to benefit at your expense. Number 2, high commissions are a good thing, right? Brokers may choose to offer you only those investments which pay the highest commissions. To illustrate this point, let's consider another example. Let's say that investment 1 is the best investment for you, but it offers no commissions to your broker. On the other hand, investment 2 is a worse investment, which pays 5% commission. Under the suitability standard, your broker is not obligated to offer you investment 1, and may instead sell you investment 2 in order to collect the commission on the transaction. This conflict of interest is currently permitted under the suitability standard, which is applicable to many brokerage firms. Isn't that special? Number 3, looks good on paper. Your broker may sell you an investment that is illiquid or highly risky. This is due to the fact that brokers are often associated with particular issuers of securities or certain investment companies. As a result, they may be limited to offering only the proprietary products sold by their affiliates, even though other more attractive investment options may be available in the market. They may also be restricted to a particular list of securities and may be compensated to offer one investment over another at any time. One of the worst examples that I witnessed was with a portfolio of a friend's mom. Her broker had sold her what he called a safe investment, which was a limited partnership. While some limited partnerships could be considered good investments, this particular one was Medical Capital Holdings. What's the big deal about that? Well, this particular limited partnership ended up being a fraud, and most investors lost everything that they invested into it. What makes the story even worse is that this particular broker thought it was suitable to put over a third of her portfolio into it. Number 4, their commissions can eat away at your returns. If you're paying commissions on a per trade basis, you may be spending more than you might expect. For example, if you're charged 2% per trade, then making just 3 trades per year could result in you paying 6% of your overall portfolio in commissions annually. Number 5, alphabet jumbo soup. Brokers may be using deceptive titles to give you the wrong impression about their compensation model and qualifications. Currently, the sheer abundance of professional designations being used within the financial services industry is confusing even to the most experienced investors. However, understanding the differences between these titles could have a dramatic effect on your long-term investment results and overall satisfaction. As an example, the term financial advisor is one of the most used terms in the industry. However, many of the individuals using this title are salespeople looking to meet quotas by selling financial products. They may in some cases sell non-marketable securities, which include long-term commitments, excessive fees, and a high level of risk. Titles with the word senior, like Certified Senior Advisor or CSA, and Certified Senior Consultant, CSC, for instance, have come under a great deal of scrutiny. I get offers in the mail all the time to buy designations. Don't let the alphabet soup impress you. The only one that should in the financial planning profession is the CFP designation. Other notables are the CFA and CPA designation. Number 6, I have a sales quota. I love when I get a statement from a competitor that's sponsored by a mutual fund or insurance company. The broker claims in them that they have their client's best interest at heart and can utilize all types of investment choices, except that the only investments I see are from that company's proprietary products. Now whose best interest is first? I assure you, not the client. Number 7, my record's clean, kind of. Your broker is not obligated to tell you if there's anything on his or her record. And why should they? It's reported that 70% of prospective clients do not do a background check on the broker before hiring them. And number 8, it could be better somewhere else. With a broker, you're dealing with a salesperson who may or may not have your best interest in mind. On the other hand, registered investment advisors, also known as RIAs, are firms which operate under the fiduciary standard, which means that they are legally obligated to put their clients' interests first at all times. You just listened to the post titled 8 Secrets Your Broker Won't Tell You and Why You Need to Know Them by Jeff Rose of goodfinancialsense.com. Did you know that only 8% of people will stick with their New Year's resolutions all year long? Well, there's one financial resolution you could actually stick to because it happens automatically. Today's episode is sponsored by Acorns, and Acorns makes it easy to start automatically saving and investing so your money has a chance to grow for you, your kids, and your retirement. You don't need to be an expert. Acorns will recommend a diversified portfolio that fits you and your money goals. You don't need to be rich. Acorns lets you invest with spare money that you've got right now. You can start with $5 or even just your spare change. We've talked about this type of automation on this show before, and Acorns makes it easy. Head to acorns.com/OFD or download the Acorns app to start saving and investing for your future today. Paid non-client endorsement. Compensation provides incentive to positively promote Acorns. Tier 1 compensation provided. Investing involves risk. Acorns Advisors, LLC, an SEC registered investment advisor. View important disclosures at acorns.com/OFD. You sign up for something, forget about it after the trial period ends, then you're charged month after month after month. The subscriptions are there, but you're not using them. In fact, I learned that 85% of people have at least one paid subscription going unused each month. Thanks to Rocket Money, you can see all your subscriptions in one place and cancel the ones you're not using anymore, saving more money. Rocket Money is a personal finance app that helps find and cancel your unwanted subscriptions. monitors your spending, and helps lower your bills so you can grow your savings. See all of your subscriptions in one place and know exactly where your money's going. Rocket Money has over 5 million users and has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all of the app's premium features. Cancel your unwanted subscriptions and reach your financial goals faster with Rocket Money. Go to rocketmoney.com/OFD today. That's rocketmoney.com/OFD. rocketmoney.com/OFD. While I really do enjoy articles warning about the downsides to working with brokers and financial advisors, I've also come to realize that not everyone has an interest in managing their own investments. And it can be intimidating to come up with your own financial plan. I know it was for me once upon a time. I don't personally work with a financial advisor because I enjoy reading about this stuff and doing it myself. But if that's not you, it's okay. You can still take control over your finances and work with someone else without paying high assets under management fees or commissions. There are really helpful robo-advisors out there like Betterment, M1 Finance, and Wealthfront that can provide similar assurances as a financial advisor at a much lower cost. And if you decide that you'd prefer to work with a human, I highly recommend that you consider a flat fee advisor. This is different from fee-based, fee-only, or commission-based advisors because most of the time they don't manage your investments for you. They're also really hard to find because only 3% of all financial advisors offer a flat fee model for compensation. They basically work with you on the financial plan and show you how to implement that plan yourself, and you're paying them a flat fee for their time and their knowledge. I'm likely going to use a flat fee advisor to double check my drawdown strategy for my portfolio as I approach early retirement. And that should do it for today. Have a happy rest of your day, and I'll see you on the Thursday show tomorrow, where your optimal life awaits.